Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. European and US stock futures dip as uncertainty over tech valuations and the Fed's policy outlook weigh on sentiment. Palantir shares slide after hours despite an upbeat earnings report. Philips reports strong order intake momentum and a profit beat as European earnings ramp up. We'll be speaking to the CEO of BP shortly and we'll break, of course, the oil majors' numbers. Plus, President Trump endorses Andrew Cuomo, threatening to withhold federal funding if Zohran Mamdani wins today's election for New York City mayor.
In the meantime, a quick check on these markets. We are seeing a little bit of red on the screen and by a massive margin. People really pulling out of this market, even though it's only the first week of November. As Anna mentioned, S&P Futures down about 1%. Look at NASDAQ Futures, it's down even more. Of course, Eurostoxx 50 Futures down about 0.9% as well. My focus, though, is on Bitcoin. Is it leading or lagging the risk-off sentiment? We're going to dive into it throughout the show. The countdown to the opening trade starts right now.
Tuesday the 4th, good morning. It is a red tape out there this morning. Futures are broadly negative. It is going to be a tough morning, therefore, if you are reporting numbers. There are many companies this morning here in Europe that are reporting numbers. BP is breaking onto our screens right now. The oil major on deck with an adjusted net that comes through at 2.21 billion. That is ahead of estimates. If I look at the adjusted EBIT beat, that looks like it's beaten the adjusted EBIT. That looks like it's beaten at the operating line as well. In terms of what they're saying on divestments, because this is kind of one of the key areas that BP is dealing with right now, expects divestments and other proceeds in 2025 to be above 4 billion. The key question we're looking for here is what is happening with Castrol. When are we going to see that divestment going through? That's a big chunky one. And that is a big part of the plan.
Yeah, absolutely. And we heard, I know you guys talked yesterday morning about some of the other asset sales they're doing. So that clearly is something they're working towards. They're giving us an update today on how quickly they'll get through those. But people raising questions about whether Castrol is the right asset to sell. But this is a business that's under pressure, in part from an activist investor who's been demanding faster action on debt, on costs, and on, therefore, some of these asset sales. Interesting in that context to note that debt gearing is actually a little bit higher than had been estimated. So that's come in at 25.1%.
Yeah, I think that it's fascinating. We were kind of speculating on the show yesterday about whether the kind of asset sales that they were talking about in the States to the tune of $1.5 billion, specifically in the Permian Basin, was something that was worth kind of front-running some of their earnings as well. So that one is a key piece. You mentioned their kind of cost-cutting. Not only are they under that activist pressure, they're also coming up a massive wall of debt in 2027 as well. So there's a question, of course, of dealing with the activists, but also a question of dealing with their shareholders and their bond holders as well.
So here's the other question as well is, what do you build this business for in terms of the oil price? What is happening with the oil price right now? There's an awful lot of oil floating around the world at the moment. Are we going to see oil prices going lower? I appreciate that recently they've gone higher. But actually, are we going to be in a situation where we start to see maybe those rolling over? Well, let's try and answer all of these questions. We have the perfect person to do so. BP's CEO, Murray Auchinloss, joins us now to talk about the figures that we are watching. Murray, good morning. Congratulations. Look like a fairly solid set of numbers. You've got a 750 million buyback going through. You've got an adjusted net that looks like it's ahead. The operating line looks like it is ahead as well. Should I focus on those figures? Or should I focus maybe on the idea that actually the gearing ratios are starting to tick higher? Should I be focusing on debt or should I be focusing on earnings this morning?
Well, good morning and thanks very much for having me. It's been a good quarter, as you said, a 10% beat on expectation, 7.8 billion of operating cash flow. And of course, we've now announced 5 billion of divestments year to date announced. The operations themselves were running very well. In the downstream, we've had our highest refining availability in 25 years, and our customers' business had the best result in history. And then on the upstream, of course, we're growing volumes 2 to 3% per year, and we've had 6 major projects come online, 4 ahead of schedule, and of course the 12 exploration discoveries. So a very good quarter, 3 quarters into our 12-quarter plan, but we've got great momentum.
OK, so the momentum is going well. Talk to me about the momentum when it comes to the divestment programme, because that is where everybody is focusing their attention right now. The name that keeps coming up time and time again in the analyst notes that I've been reading is Castrol. What is happening with Castrol? When are we going to be seeing that disposal going through? And are you still convinced that's the right move?
Sure. So what we announced in February, 3 quarters ago, is that we divest $20 billion of divestments across a 3-year time period to 2027, and that would help lower our debt from about $26 billion at third quarter to $14 to $18 billion by 2027. We're strongly in action. We've now announced $5 billion, including the announcement in the U.S. And over the past couple days. And so we have confidence that we'll hit that $14 to $18 billion. Remember, our net debt is $26 billion in the quarter. That was despite paying down $1.2 billion in the hybrid and despite a higher tax bill in the quarter. Of the $5 billion of divestments, $3.5 billion is still yet to come to the balance sheet once they complete. So that, of course, will show progress as well. And then on Castrol is performing really well. 9 straight quarters now with profit improvement, quarter in, quarter out, and strong interest in Castrol. And we remain confident that we'll be able to transact on it.
Murray, why sell it? You've just outlined a case for a really solid business that has a low cost of capital, that generates really decent returns. If I'm an investor, I'm looking at this going, yeah, OK, so that's part of the disposal program, but it's a great business. So why are we thinking about disposing of it?
Yeah, it is a great business. As I said, 9 quarters in a row with earnings growth, and Michelle and Emma, who are leading the team, are doing a great job. But it's the least integrated of our businesses. We have a strategy to grow our upstream, to tightly focus our downstream on the most integrated businesses that support trading, and then to invest very carefully inside transition. And with Castrol, it is a great business, but it's the least integrated. We don't have base oil, and I think it'll be of more value to others than necessarily to us. So we continue on our process, and we remain confident. With that process.
Murray, it's Kriti in London. Let's pivot to a little bit more of the macro agenda. I'm curious on your take on these oil markets right now. We have new sanctions coming out of the United States on some of the major Russian players. We have an oversupply, and we have an OPEC plus cartel that continues to hike out output. Where do you think oil prices end up in 2026?
Yeah, I think it's very difficult to predict oil price. Probably the hardest thing in the world. What I will say, though, is as you look through, demand remains strong. We continue to see 1% demand growth in 25 and 26, so very strong demand growth. And from a non-OPEC part of the world, the non-OPEC plus, we see production peaking somewhere in February, March, April. From there, we expect it to flatten and decline as far as the eye can see. So really, price is going to be determined by 3 factors. What happens with OPEC plus? You saw the action they had on Sunday. What happens with these sanctions? They're pretty serious sanctions. And then what Chinese behavior is on storage. Those are the 3 things that will determine the price. For us, it doesn't really matter. What we're focused on is running a solid business. Uptime's at 97% across the entire portfolio. We're driving costs out of the business, and we're repairing the balance sheet. So we focus on a low price environment, and any price upside will just benefit us.
Well, Murray, speaking of that low price environment, there's starting to be some speculation that the oil prices are headed to be in the low 50s. We've heard that for analysts on the show. We've heard that from some of your peers as well. And it's certainly been a conversation in Abu Dhabi where you are right now. Is that valid? If we're talking about some of the trade uncertainty, if we're talking about a growth slowdown, is that a plausible scenario, low 50s come 2026?
Well, I'll just go back to the basics. You have to look at supply and demand when you think about these things. And demand remains robust at 1% growth. In fact, we saw gasoline demand increase 5% across Europe so far this year. So demand growth is strong, and through cycle, that's what's so important. And then on the supply side, again, it really just depends on what happens with these 3 big macro factors that are very difficult to predict. So let's just watch and see what OPEC Plus does. Let's see how these serious sanctions impact supply, and let's see the Chinese behavior, and then we'll be able to determine what happens with price.
Good morning to you, Murray. So you've set out the 3 things that you think will then determine that price. Talk to me about the link between price and your balance sheet. You're clearly taking very seriously what you need to do around the balance sheet. Does that get harder with a lower oil price? Do you need to sell more assets with a lower oil price?
Well, you saw so far this year, or you saw in this quarter, that we were able to keep the balance sheet flat despite paying down the hybrid and despite a higher tax bill. As we look forward, there's $3.5 billion of proceeds from our announced $5 billion in divestments that haven't completed yet. Those will go to the balance sheet, so we'll have good momentum with those over time. We also have the divestment that we just talked about with the rest of the $20 billion program, including a potential transaction on Castrol. So we remain very comfortable that we'll hit our $14 to $18 billion target. It's a primary target for us, and we will adapt as we go along.
Okay, can I ask you about Brazil finally, Murray? You last week provided an update on some of your offshore oil discovery activities there. How many barrels do you see there, and what does the drilling timeline look like? Because you previously talked about this as being a really significant discovery for BP.
It is significant. It's a 1,000-meter column of hydrocarbons. The first 100 meters are black oil. The next 900 meters above it are rich gas condensate. So it's a very good reservoir. We continue to take samples, and we'll evaluate those samples, including the sidewall, and that will enable us to be able to tell you what the volumes are in place, and that will come in due course. In the meantime, we've contracted a rig, and we've contracted the equipment for a flow test, and we look forward to moving into that phase of the development in the back end of 26 and into early 2027. We have a team stood up to look at an early production system and a full development scheme. This is the largest discovery we've had in 25 years, and we're really looking forward to progressing it.
Murray, thank you so much. Thank you for joining us. Really appreciate it. BP CEO Murray Auchinloss, thank you for your time. It is 11 minutes past 7 here in London. Let's get to the earnings story more broadly. So we've had decent numbers out of BP. We've had decent numbers out of Phillips as well. Better than expected. North America doing well. AB Foods, they're also decent numbers, but bigger questions around the structure of the business. So they're saying they're confident in the medium and the long-term growth prospects, but they're doing a review that may lead to the separation of Primark and of food. I mean, for many, many years, these have been sort of slightly awkward bedfellows, perhaps, in terms of operating in very different environments and very different sectors.
This is a very weird business in so many ways. Like it is closely held by the Western family. The free float is very, very low. It is basically a family-controlled business, which is why maybe you've had the structure that you've had and not had maybe you could argue a more rational approach, which will be to separate out retail from food. They are odd bedfellows, as you say, in terms of the nature of the business.
We should talk about Hugo Boss as well, which also came out with some of their numbers. It looks like they're reporting within the guidance, but the lower end of the guidance. It doesn't feel like it's going to be received well at the market open.
Absolutely. So against the flow of what seem to be quite a lot of larger businesses reporting ahead of estimate, that one is certainly a negative that we watch.
Okay, so but you take a step back, you think about what's happening with the consumer. Consumer in the States, there's signs already within the numbers that we're watching at the moment of a weaker consumer reporting season. This would maybe be evidence of this. I don't know whether you put Hugo Boss into the luxury sector. I don't think you probably do.
Somewhere in the middle, isn't it? Yeah. Which is where things would be more difficult, perhaps.
Tough place to be, maybe.
Yeah.
And you could certainly argue that. The consumer, you have this sort of K-shaped recovery. If they sit right in the middle of that K, that's a tough place to be. I don't know. There is growing evidence, and there's a number of notes I read this morning, one that really stands out about what's happening with the consumer this morning. Yeah. And where we are going in terms of that narrative.
Shall we talk about what's going on in markets and tech and futures? Yeah. Because European futures might or might not be responding to some of the earnings stories we've just headlined. They're a little weaker, but the US futures are certainly responding to tech and Fed talk.
So there's two things happening. So the first thing I want to say is Nasdaq futures are at session lows. So just bear that in mind when you think about what we're going into this morning and companies that are reporting numbers this morning. When you see what happens with the tape this morning, you've got to bear that in mind as the backdrop. Nasdaq futures are at their session lows, as you can see. As you say, Anna, there's a couple of factors behind this, one of which is Palantir last night, which went past expectations.
Yeah.
But the whisper whatever analysts have got, clearly the market was expecting more, and you've had this massive rally. And here is the problem, that you've had this massive rally. And maybe the biggest problem that actually some of these tech companies are going to find is that they've had massive rallies, and therefore surpassing that is going to be difficult. Now, that's not true for all. You take a look at what is happening with Microsoft, for instance, and Microsoft has gone sideways. Palantir hasn't. So it's going to be interesting to see how the market differentiates this morning. Yeah. But then you've got the Fed talk. Like Goolsby, I don't see a reason for a cut here, another cut. You've got Lisa Cook sounding like she wants to worry about employment, but still not committing to a December cut. There's a lot of things going on here that feel market negative this morning.
Yeah, the pendulum's kind of shifting towards more of a hold when it comes to the Fed speak. I want to come back to the tech theme, though, because we're talking about some of the momentum coming out of the equity market in the tech space. The bond market, on the other hand, feels like it's catching up there. The one that really blew my mind over the last 24 hours is Alphabet coming out with $22 billion worth of bonds issuance in the U.S. and Europe, so a double kind of issuance story. they were met with $90 billion of demand. This is the same thing that we saw with Oracle, with Amazon, with Microsoft. Every time a tech company taps the debt market, they're met with a lot of love.
And we could get a lot more of this kind of supply going into the year end. These businesses try and use that window before year end to kind of get this kind of business done. As you say, maybe not too much reason to worry about spreads blowing out then, if demand is as strong as you say. And JP Morgan making that point.
Let me give you another kind of take on this. Alphabet doesn't come to the market very often. Okay, and when it does, it usually signals the rates are going higher, not lower. So actually, you could argue this is a contra-signal. That actually the market is that Alphabet's timing is good, and as a result of which maybe 20, 30 basis points higher in yields would be the result of this.
And I should, as we're talking about tech and everything that tech has delivered us in terms of higher stocks over this year, I should just mention that we've been hearing from a number of really big voices from the US banking scene overnight in Asia, in Hong Kong. David Solomon, Ted Pick, talking about the possibility of a pullback in stocks and talking about, yes, maybe 10, 15% is possible, casting that as extremely normal, extremely within the realms of what happens in normal cycles. But will it feel very normal given the amount of drama and excitement around AI right now?
What goes up must come down at some point. I mean, gravity.
That so hasn't been true for a long time. But okay.
No, but at some point, some point. And look, the market's been up 16.5% year to date, so a 10% drawdown.
Off its lows, it's up much more than that.
Sure, but year to date, 16.5%. Let's talk about the other story that, of course, is on the day ahead today. We have a special election in the United States. We have the New York City mayoral election. The early voting has been underway for about a week. We also have the Virginia special elections and the New Jersey governor. This is a lot of jargon for an international audience. I think what you need to know here is that we might just get a litmus test of what, one, the rest of Donald Trump's presidency might actually look like, how much support he has in the congressional makeup, and two, whether we start to see the American electorate start to shift a little bit towards the Democrats. And that matters a lot for the Wall Street audience, simply because if Zohran Mamdani becomes next New York City mayor, does that portend higher taxes? Does that portend rent control? Does that change things for some of the biggest players in the largest financial capital in the world?
Maybe. But you could always go to Florida. I do wonder whether, though, this...
Are you moving to Miami, guy?
Not in a hurry. But I think you have to look forward to the midterms now. We're a year out from the midterms. And what happens if the Republicans lose the House, I think, is a key kind of piece of the puzzle. I think that'll be really interesting over the next year to talk about and think about that and what the implications will be.
All the deregulation, all the momentum that you've had that's over the markets right now, that could go away in a snap.
Right, yes. I mean, it seemed as if at the beginning of the Trump administration, everybody stressed about tariffs and then became more thoughtful about deregulation, should we put it that way. And that seemed to be some of the motivation behind some of the exuberance maybe we've seen in markets of late.
OK, talking of exuberance, there isn't any this morning, certainly when it comes to equity futures. We are down. Nasdaq futures are at session lows. European equities are down and looking like they're going to be down hard as well at the get-go this morning. You've got a number of equity stories that you need to fold into that narrative. What does it all tell us? We're going to find out. Jeff Yu, BNY, Senior EMEA Market Strategist, is going to be joining us. James Clarke, Blue Owl, Global Head of Institutional Capital, a little bit later on as well. So many more earnings that we've got to work our way through this morning. In a moment, we'll hear from Roy Jakobs. He's the CEO over at Philips. That conversation is at 7:30. Up next, AIB Group CEO Colin is going to join us from Dublin on its numbers. We'll do that next. This is Bloomberg.
Good morning, everybody. Welcome back to the programme. 7:21 here in London. We have the earnings stories coming thick and fast this morning. Let's get to the next one. We're joined by the CEO of AIB Group, Colin Hunt, who is with us to talk about the numbers and the story behind them this morning. Colin, good morning to you. So in terms of the numbers, I've got the guidance you're giving this morning. Total income in the third quarter down by 10%, according to the headline on the Bloomberg terminal. But I understand you're upgrading your guidance. So tell us how good things are at AIB. What's the driver behind that upgrade?
Good morning, Anna. We've had another good set of numbers for the third quarter of the year, pointing to the ongoing resilience of the business. Our NIM was 275 for the first 9 months of the year, exit NIM of 270, ongoing good cost discipline, cost-income ratio of about 44%. The CET1, we had organic capital generation over the course of the 9 months of 250 basis points. That isn't even featuring in our CET1 of 16.6% because we're holding that back pending a decision at year-end on distributions. So the underlying driver, of course, is the performance of the business, Loan book growth it was very good. New lending growth was up 5%. And we're looking forward to a full year number now, full year set of numbers now. We've got obviously 10 months booked now. We've got a very clear line of sight towards the year end. So we're nudging our full year guidance for net interest income up from greater than €3.6 billion to greater than €3.7 billion. At the same time, the book is performing very, very robustly. We are now guiding that our cost of risk will be at the bottom end of a 20 to 30 basis points range. And we are reiterating that our ROTE this year will be above 20%.
Colin, good morning. It's Guy. Are you seeing any indications that, A, the tough international environment that you referenced a number of times in the statement this morning is beginning to impact the Irish economy? Are you seeing any indications that credit is becoming more challenging in terms of what you're seeing in your numbers? Can you just give us a sense of what is going on under the hood in terms of how these drivers are affecting the business? And are you in any way worried by what you're seeing in the States when it comes to the credit position as well?
Oh, well, first of all, I think that we were dealing with an awful lot of uncertainty driven by tariff uncertainty earlier this year, and we're dealing with far greater level of predictability now. The fact of the matter is that we're seeing no sign of weakening in terms of the key credit indicators, something we monitor obviously very, very closely, and that's a reflection of the strong underlying dynamic in the Irish economy, which continues to grow at a decent clip. Now, the growth rate that we've experienced in recent years, unlikely to be repeated. We look at modified domestic demand, which excludes the volatility that we see in Irish GDP numbers, or at least adjusts for that volatility. And while we were used to numbers of 4% in the past, the fact that we're dealing with a world trade system that has more friction in it is likely to lead to Irish modified domestic demand growing by something of the order of 2 to 2.5% in the next number of years. So while it is more modest than our recent experience, it still is looking quite good, particularly by reference to our partners in the European Union. And on the point of what we're seeing in the United States, I'd just like to state very clearly that AIB has no direct exposure to the private credit lending market in the United States.
Colin, let's talk about another risk, of course, that's, I think, on everyone's radar, but is quite magnified specifically in Ireland, and that is the commercial property sector. I believe Blackstone has recently handed back the keys when it comes to an office portfolio in Dublin to you. Can you just walk us through the dynamics in your CRE loan book here? Are you worried about the commercial property sector in Ireland or broadly Europe?
Well, as bond yields went higher, we would have seen a significant correction in the CRE market and in the valuation of commercial properties here in Dublin, particularly in places like office and in retail, less so in residential and in industrial property. But I think we're well through the bottom of that valuation cycle now, and in fact, we are beginning to see signs of a pickup in CRE activity in response to the fact that we have seen a very significant correction going back over 2.5 years now in terms of the underlying value of those assets.
All right. Colin Hunt, AIB's Group CEO. We'll leave the conversation there. We thank you so much for your time joining us, of course, from Dublin. We continue the conversation when it comes to the earnings picture. Philips delivering a beat on the back of robust demand for its medical devices in North America. We're going to speak with the CEO, Roy Jakobs, soon. In the meantime, keep an eye firmly on these markets because, of course, the futures are continuing to sell off on both sides of the Atlantic. I'm looking at U.S. futures down about 0.9%. The selling is even uglier when you look at the NASDAQ. It's even worse when you look at Eurostoxx 50 futures. How much of this is responding to an actual catalyst over in the States or in the European session yesterday? How much of it is just taking some cash off the table? New month, new perspective. We'll dive into those dynamics. Stick with us. This is Bloomberg.
Tuesday the 4th, good morning. 30 minutes to go until the start of cash trading for European equities. And I have to say, it's an ugly outlook. This is what the picture looks like right now. Euro Stoxx 50 futures down by 1.1%. Stateside, we've got the S&P down by, let's call it circa 1%. The Nasdaq is down by 1.3%. It's just bounced off its session lows. So an ugly outlook when it comes to the equity story this morning. Tough tape if you're reporting numbers, Anna.
Yeah, absolutely. And where does that send the money? Perhaps into bond markets. Perhaps that knee-jerk reaction is still there. We have yields a little lower in the United States on treasuries. We have yields a little bit lower here in Europe as well. And we have these bank bosses over in Hong Kong at a conference there, talking Wall Street CEOs, talking about the possibility of pullbacks in stocks. And that could be something that sends people into bond markets for a little bit of cover, Kriti.
The bank bosses at it again. Perhaps we can blame them for the futures move as well. In the meantime, we've got one eye firmly on the earnings picture, especially here in Europe, where things are actually looking pretty solid this morning. Specifically, when you look at Philips, shares are indicated to open higher after the Dutch company beat profit estimates with order intake climbing, get this, 8% in the third quarter. It's all due to robust demand for medical devices in North America. Joining us now, I'm pleased to say, is Roy Jakobs, the CEO of none other than Philips. Roy, a pleasure to have you on the program. Thank you so much for your time. We're looking at these numbers, and we're pretty surprised at the positivity here, simply because we've had a conversation with you in previous quarters about some of the macro headwinds that could get in the way of this kind of outperformance, things like the EU-US trade deal. What's the secret sauce here, Roy?
So indeed, I think we are quite pleased with a strong quarter. You see strong momentum on one side. The order intake, you called out 8%, based upon double digit in North America, but also we see a very strong personal health performance. So strong demand for our consumer products, which also supports our sales step up in growth. And then indeed on the margin, we are facing 150 to 200 million of headwind of tariffs. But we have been taking very strong measures, both in productivity and cost, so that we can expand the margin. And I think that's what we saw in Q3. And we also, as a result, see that we can continue the effectiveness of that program into Q4. And that will help us then also to come in at the higher end of the ranges for the year. It's also supported by the step up in sales and stronger realization of value of our innovation. So there's a gross margin part which is strengthening. And we are very disciplined in our cost and continue to drive productivity. We have upped our productivity program that we had for the 3 years period from 2 billion to 2.5 billion, 800 million of that this year alone. And that's actually helping us to offset, of course, a significant headwind of tariffs. And that also gives us a good platform to continue to build our margins upon.
Roy, just anecdotally, before we go into the rest of your numbers, what are you actually seeing from your customer base, from your clients, in terms of actually being able to absorb any potential additional costs, in terms of the resilience that you were seeing in North America? How does that fare, to your point, in the face of some of these very strong tariff headwinds?
Yeah, so the reality is that our customers and the healthcare system is under a lot of pressure already. We see actually pressure from the fact that they don't have enough workers, doctors, nurses and technicians to serve their patients, but also the fact that indeed additional cost burden doesn't help them to fulfill their duties. At the same time, and especially in North America, we see also that they have been strengthening their operations and have been able to help more patients since COVID. And that actually gives them also the need to reinvest further. And that's what we see then coming back to our demand. They want to have strong platforms where AI actually is enabling them to do waste in a different way and actually to help them to become more productive. I think the key story in North America, but also across the world in healthcare, is how can we make healthcare more productive? And that we can do with doing healthcare in a different way with the help of new solutions and the platforms that are very much AI fueled. So that's something that we see coming in as a big theme, where jointly, as an ecosystem in care, we make sure that actually we can keep it going. Because I've also been saying every dollar spent on tariffs is $1 not spent on patient care. And we need to keep innovating patient care because of the amount of patients that we see growing, the chronic diseases that are growing, and therefore the solutions that need to cater to that.
Thinking about tariffs, good morning, Roy, it's Anna. Thinking about tariffs, can I ask you about the possibility of further tariffs as a result of this Section 232 probe by the US administration on medical devices? I know none of us has a crystal ball. We don't know what will happen here. But what is Philips assuming? What is your base case assumption about that?
Currently, we have assumed the current tariff levels as the base for our plan, and we also keep that reality because it's very hard indeed to get into any crystal ball, so we don't want to get ahead of ourselves. So we take the realities as we face it, as the ones that we have to deal with. But we take proactive action. We also, for example, in Q3 announced that we were further strengthening our footprint in the US. We have announced a $150 million investment plan in Reidsville, where actually we are expanding our ultrasound facility and actually delivering wider products to the North American market. We have been doing the same in China, where we have been localizing more, but also in the rest of the world to make sure that we have regionalized our supply chain and localized our supply chain to deal with any change upcoming. Because the one thing I think is a given that there will be ongoing changes. We need to have the agility in our operation to address them head on and fast. And what we've been seeing, and that's also, I think, building the trust with customers, that we have been reassuring them and delivering the products as per our commitments. Service levels are up. Supply chain delivery actually is better than we had before. That's also coming off the strong investments we have done in our fundament in the last 3 years.
Roy, and you talk about customer trust, and I know you've been trying to rebuild that over recent years, so it must have been quite a blow to receive 3 warnings from the FDA, so focusing on the United States. Their findings around 3 of your plants, a failure in the complaints handling process, lapses in processes in another location, and other complaints. Now, I know you've said that this is not going to be significant for the business or material for the business, but you do take this seriously. But this must be quite a blow, given the way that the business has been trying to turn the page after the Respironics issue of years past.
No, this is clearly a disappointment, and we do take it seriously. We also are in full remediation already since Q2. So actually, we have been remediating since we got the report. Also, just zooming out a bit, we got 9 inspections, of which 6 were fully clean, 3 were not. So there we got the findings, and we have more work to do. But at the same time, we also have been working very constructively with the agency. And for example, this year we got 27 new approvals for innovations that we can serve the market with, which is more than the full of last year. So actually, we are making progress. We need to continue on that path. And that's also what you see then back in the operation that is not being disrupted by it, because the order growth, the sales growth, and the margin expansion continue to go on step by step, as we have been planning for. So it's a combination of the two that we need to manage so that we can deliver to our consumers and customers.
Roy, good morning, it's Guy. The US looks strong. That certainly is evidenced in these numbers. What about China? What's going on there? What's the outlook in China?
So China is not that strong. The market still is subdued, although we see a slight difference between the consumer market, where actually we see a slight recovery and we are also benefiting from that and actually starts to contribute to our results. Where in the healthcare side, you still see that the market is very much disturbed by a lot of government intervention. The anti-corruption is still playing part. The new procurement processes that they have introduced prolong the order finalization time. So actually that market is still not very strong for us. Therefore, it's so important that actually we see the North American market really doing well.
Okay. Can I just sort of zoom out and talk about China and the United States and just focus on what is happening there? Every time you go into an MRI machine, you realise how big a piece of kit it is and how complicated they are. One of the key ingredients into an MRI machine is a series of rare earths that are quite critical. Those rare earths are in short supply right now. Do you have a problem? Will you have a problem? How are you managing the rare earths issue?
So we don't have any immediate challenges with rare earth. We are having a secured supply chain on our end that actually makes sure that we can supply to our customers. Actually, we have been investing our resilience of our supply chain so that we actually can really deliver the orders and the sales. And actually, the fact that the Indonesian order that we booked last quarter, we can already turn and we will install the first site this quarter is really something that shows the resilience and the strength of our supply chain. And then on top of, we have been taking really the cost measures to also make sure that we can keep it at a cost level that actually supports our margins.
Do you think Europe needs to do more to secure supplies of rare earths right now?
I think that's not necessarily for me to comment on. I think we have been really working on securing our supply chain. That is working. You see that in sales and orders, and also in the trust levels of customers that are increasing. And we also keep engaging with governments across the world to make sure that indeed they don't put the pressure on healthcare as a system, but actually we can delivering better care to more people. And that's the focus that we are on.
Roy, we've talked about tariffs. We've talked about government intervention on both sides of the Atlantic and Pacific, frankly. We've now talked about rare earths as well. How much of this is showing up in your pricing? Are you already charging your customers the higher end of your range? How much cushion is there to increase those prices?
So actually, if you look to the offsetting measures that we have been working, and also if you look to our margin expansion, there are two sides. One is we have stronger gross margin because the innovations that we're having are delivering higher value to our customers. That's not necessarily through higher pricing, but actually through the partnerships that we close with them and also the services that we deliver. They're willing to pay a higher amount for it because they see the return value. We have not been actively strongly increasing our prices. We have been taking that burden more upon ourselves. That's why we have been expanding the productivity program to the 800 million this year, but also we stay very disciplined on cost internally. So actually we can address some of that 150 to 200 million fully within our own measures. Of course, there's some pricing as part of the mix, but if you look to the totality, that's not driving our margin expansion for the largest part.
Roy, great to catch up. Thanks for the time you spent with us this morning. The Philips CEO, Roy Jakobs. So it's turning out to be a big day for European earnings.
The operations themselves were running very well. In the downstream, we've had our highest refining availability in 25 years, and our customers' business had the best result in history. And then on the upstream, of course, we're growing volumes 2 to 3% per year, and we've had 6 major projects come online, 4 ahead of schedule.
18 minutes to go until the market open. Futures are soft. Corporates are reporting. How does it all mix together? We're going to find out next. The European market open is coming. This is Bloomberg. 15 minutes to the market open. Let me give you an update on what's happening because it's pretty ugly out there. As you can see, futures are lower on this side of the Atlantic. There's a whole load of corporate news we need to fold into this as well. But broadly, the narrative has been US futures down. Asian markets were under a little bit of pressure. Europe's looking like it's going to be under pressure as well. Let's take a quick look at what is happening with US futures, just to give you a kind of guide as to what is happening there. The Nasdaq in particular is under significant pressure. It's not at session lows, but it's very, very close to session lows as we speak, going into this session this morning on Tuesday.
OK, so that's the picture on US futures. European futures, as you say, Guy, then also showing a little bit of weakness. One thing that we're going to be watching as we go through this morning is an update on the UK fiscal picture and the budget plans of the UK Chancellor. She's going to be speaking. Chancellor of the Exchequer Rachel Reeves is expected to address the nation shortly as she prepares the public for what's expected to be a tax-raising budget. It comes as the Resolution Foundation says the UK's fiscal gap is smaller than previously expected, giving Reeves more room to tackle inflation. Joining us now is Bloomberg Markets Today co-editor Mawena Koniam, who, of course, watches the UK market and the UK story very, very closely. Mawena, good morning to you. What can we expect from Reeves, then? This government, for a long time, made a great deal of fuss about not increasing taxes on what they call working people. Are we expecting some kind of nuance to that language, a step away from those commitments, perhaps, in some way?
Well, I think obviously there's a reason why she's going to be giving this speech this morning, which is very unusual for a chancellor so close to the budget. It comes ahead of her cabinet meeting this morning. And Keir Starmer has said that, reiterated the warning that there are going to have to be tough choices. So I think that we are expecting there to be, something along those lines. I think it is particularly interesting, as you said, that it comes amid this new analysis suggesting there is a bit more fiscal headroom than was expected. They're pushing her to do things like move some of the levies from energy bills, into general taxes and actually bolster that fiscal buffer further. And that's something, obviously, the markets will be wanting to see. So I think what we'll be watching very closely, this speech around 8 is going to be when the bond market is open. So we'll be watching quite closely to see how that reacts as well.
Absolutely. In the meantime, Mawena, the Resolution Foundation says that Reeves has more room to tackle inflation. What do you make of that?
Well, I think it's quite interesting. This is all coming due to wage growth being faster than expected. And they say that's going to offset, some of the more negative forecasts that have been coming into play. It's one of those weeks where we do seem to be sort of ping-ponging between things seeming worse than they were thought to be, and then things perhaps not being so bad. Obviously, this is reassuring for her. It could be reassuring for the market as well. But whether she chooses to sort of capitalize on the extra room that she's got to do what she's suggested she might want to do, which is make a bigger buffer for herself. As a result of it, I think will be quite interesting, or whether, it's a sigh of relief that perhaps things don't need to be as severe as planned. But the messaging this morning seems to be that we are going to see some tough decisions. I think the real question will be whether they break those manifesto pledges in doing that.
Moana, great stuff. Thank you very much indeed for the update. Moana Conningham, ahead of the key speech that the Chancellor Rachel Reeves will be giving shortly. We'll bring you some of that live in around 11 minutes' time, which is when we think it's going to start. It's not a precise start, but kind of roughly around that kind of a moment. Let's talk about what futures are signalling this morning. They are negative. We see a lot of red across the screens this morning. We're 11 minutes away from the equity market open here in Europe. So a sharp move lower, but not sharp enough maybe to burst the bubble, according to our executive editor, Mark Cudmore, who joins us now. Mark, you're not worried?
Longer term, or I should say medium term, maybe I'm not worried. Look, I want to emphasize the core view here is that we are in an AI bubble, specifically an AI capex bubble, and at some point it's going to burst. It's going to burst nastily. Is this the burst? I strongly don't think so. We've talked about in the last couple of weeks that at some point we're going to get into the more volatile part of the bubble. It's not even clear we're in that yet. Bear in mind, this sell-off is really mild at the moment. There's no reason why it can't continue from here. But to put as a comparison, between October 1999 and March 2000, the NASDAQ 100 had more than 4 10% plus sell-offs and a gazillion other 5% plus sell-offs, while the index doubled in just 6 months. So that was the kind of volatile final stage before it then peaked out and then kind of collapsed. And that is what a similar kind of playbook to the AI. Obviously not the exact same parameters. I think the cycle is quicker this time and much less volatile. So I don't expect the index to double from here. I don't expect to have as many big drawdowns, but I expect us to get into a more volatile stage of the market. And maybe that's what we're entering now.
OK, good morning to you, Mark. Let me ask you about the link between stocks then and other US assets, and specifically the dollar. If we do see sell-offs in US stocks, and let's assume they're just they're small sell-offs, and then we go back to the strength that you've been describing, Mark. If we see that, how does the dollar respond, do you think?
I think the dollar is going to strengthen into year end. It's not going to be some kind of parabolic story. The positioning is relatively flat. I think there's a little bit of upside for yields amid the uncertainty about what the Fed will do next. As soon as stock markets start bouncing again, it seems hard to be cutting into a financial assets bubble. There's not sign of the economy falling off the cliff yet. There's clearly divide in the Fed. So I think there's potentially a little bit of upside for yields. Positioning's relatively flat. I think if we get extreme risk aversion, so let's say we see the stock market sell off another 5 or 6% here over the coming days, well, then we'll see a little bit of a dollar boost from risk aversion, just a deleveraging phase, not because they believe in the dollar longer term. On the flip side, because this is an AI bubble, it'll be the AI stock market that bounces first. And as I said, I don't think we're at the final end, so I expect we'll have another bounce. And in that bounce, it'll be US stock market that bounces first, and that'll support the dollar for inflows. So overall into year end, I expect the dollar to be strengthened, but not be a dramatic trade.
Mark, bond traders love to say that they lead the stock market, that the stock market responds more to bond moves. When it comes to the AI theme, though, we're seeing a lot of the mega cap players start to issue debt that credit investors are gobbling up. Is this a moment where the stock market is leading the bond market?
It's a great question, Kriti. I am massively in the camp that fixed income traders lead equity traders in the longer term. But I think in this cycle, it's clearly equity traders that have the lead. And, maybe I was too young to register. That's what happened in the dot-com bubble as well. But most of the intervening period, it has been fixed income that's led. But right now, it is all about AI. And it's the equity traders who know that it's unlikely to be the bursting of the bubble yet. We're not seeing the fundamental catalyst for that bursting to happen. And therefore, stocks lead fixed income for now.
All right, Bloomberg Markets Live executive editor Mark Cudmore. We got to get that bit, kind of a soundbite clip there. Stocks lead bond investors for now. We thank you so much. More analysis from him and the team, ML Ivigo, on the Bloomberg terminal. Let's go from the macro to the micro and get our stocks to watch with Chloe Melly.
Good morning, Kriti. Let's start with BP today, which reported profit ahead of expectations thanks to higher crude and gas trading, despite some weaker oil trading. So this could potentially boost the shares in BP this morning after what has been a few years of underperformance for that company. This set of results also is boosting confidence that the ongoing turnaround is starting to pay off, with the CEO saying that although there is still more to be done, there's more asset disposals to be done, more cost cuts to be done, that this is a company that is moving at pace and trying to deliver for those investors. So we'll see how those investors actually react to this news this morning. Moving on to Philips, a company that makes both electric toothbrushes and MRI machines. It could be moving higher today after reporting a stronger sales, stronger orders, thanks to strong demand in North America. So this could boost what has been otherwise quite an uneven performance for the company. It has received a letter from the FDA saying that some of its manufacturing sites were not up to standard. It's dealing with some weakness in the Chinese market and potentially threat of new tariffs on medical devices. So not all is rosy for Philips, but maybe this set of results would provide some of that relief. And finally, Ørsted could also be on the move today after Apollo announced that it will invest $6.5 billion in a UK offshore wind project. So this is quite good news after a string of setbacks from the company. We remember this massive dip in August after it announced a $9 billion rights issue, which really sent those shares plunging. But this is potentially announcing brighter prospects for that company, and we'll be hearing more at the earnings tomorrow as well.
Chloe, thank you very much. Chloe Melly with some of the stocks that could be on the move. We'll be watching those. We'll also be watching Rachel Reeves, the UK Chancellor. She's going to be speaking very unusually this close to her budget at the end of this month, speaking about the UK fiscal choices, the tough choices that Keir Starmer has talked about ahead. I mean, never let a good crisis go to waste seems to be something that comes to my mind today. They're going to be seeing a downgrade to productivity estimates by the OBR, so maybe that gives them room to be more radical.
Taxes higher. Is that more radical? That
Maybe.
seems to be the narrative. They don't want to cut costs, which is something a lot of people are suggesting maybe they should. Certainly the gilt market. Just raise taxes seems to be the answer. Let's see how that goes down. Coming up, the market open. Futures are negative. This is Bloomberg. We're about to open for European trade. Gilts are about to open. European equities are about to open. If I'm being honest, this Tuesday morning, I'm not sure how useful this board is. So this is yesterday's session over in the United States. The S&P Europe went out here. We're a little higher off that close here in Europe. The problem with it is that basically since then futures have rolled over massively on both sides of the Atlantic. The Asian session wasn't particularly clever either. US futures are negative, and Kriti, European futures are negative as well.
Yeah, in a really big way. And you're starting to see it sell off even more as we get closer and closer to the open. Do you start to see a little bit of buying the dip at the open or accelerating and magnifying the move that we already see? To me, I think what's really crucial to point out here is the gap that you are seeing between the FTSE 100 drop, Anna, and the Eurostoxx 50 futures drop. That is almost a 0.7 of 1% divergence between the two. You are also seeing French stocks really weigh on the index, at least when it comes to the CAC 40 futures. That's the underperformer of the continent this morning. Yeah, absolutely. So we'll watch how those overall indexes open up then at the start of trade. Kriti, let's have a look at some of the individual stocks and indeed sectors that we've got in focus this morning. BP certainly in focus. The numbers from BP coming in ahead of expectations. Talking about, buybacks, part of the conversation once again, of course, but also talking about asset sales, defending to us the decision that they want to sell Castrol and giving us some confidence around when that's going to happen. Telefonica in focus. Could that be a little bit weaker at the start of trade? The Spanish telecoms business cutting its 2026 dividend in half to fund a new strategy. So a big change over at Telefonica. We'll certainly keep an eye on that one. And health stocks in focus. We've had numbers out of Fresenius Medical. They were better than expected. Coloplast also in focus. But Philips is the one we focused on this morning, topping expectations, talking positively about what they can do on productivity and cost guide to take on tariffs.
OK, here we go. Are you ready? Tuesday session's about to get underway here in Europe. Doesn't look good. We're going to see maybe some interesting volatility in some single stocks. What are we going to see in terms of the index levels? Expect that FTSE number to actually be one of the best numbers you're going to see this morning. It's only falling a little bit at the get-go. Could take a little while to get some of the other markets open this morning. We're going to watch the German market very carefully. As Kriti points out, we're going to watch the French market very, very carefully. We're going to figure out how we fold in some of the corporate news that we are watching this morning around Europe. But the kind of the overarching picture here is one of of negative futures on both sides of the Atlantic, and that is what you've got to think about this morning when you look at what is happening with these markets. There's a kind of index narrative. The CAC is down by 1.2%. Stock 600 is down by 0.8%. The IBEX is down by 0.9%. The FTSE 100, we'll see how BP gets folded into that market this morning, only down by 0.4%. Maybe it's more defensive nature adding to the kind of to the safety net that it maybe provides in the European space this morning. Phillips is opening up. We're just starting to get some numbers on Phillips. So some of the single stocks that we've been watching, it is higher as anticipated at the get-go of trade this morning. I think it's going to take a while to get the DAX open this morning. So let me hand things over to Kriti Gupta.
Well, I mean, this is a fascinating market here, and I'm kind of feeling a little bit of victory lap because some of the interviews that we had in just the last hour, those are the stocks that are rallying this morning and moving the index to the upside, but broadly, ultimately can't outweigh some of the negativity you're seeing. Your biggest index contributors to the downside is really the technology sector. I'm looking at ASL, Schneider Electric, SAP, kind of mixed in there with, like I said, a lot of French stocks and a lot of defense stocks. On the surface, Anna, they're starting to look a little bit like some of the companies that are facing the valuation question and the perhaps the frothy multiples question. They're the ones that are leading the decline.
Yeah, and that always plays out slightly awkwardly in Europe. It isn't quite, just those Mag 7 AI heavyweights, of course, but there have been many companies that we've talked about in the next breath after we've said AI and Mag 7 here in Europe. So certainly there is a focus on those technology stocks. But interesting, on a day where London outperforms, and it is down, but it's down by 0.5%, with the rest of the market down by more. Basic resources is the worst performing sector, so we're down by 1.8% on mining stocks. We have got an iron ore price that is considerably weaker this morning, down by 1.3%. So that seems to be something that is taking the edge off London. It would be doing better were it not for that. And the DAX is still not open. Just make that point as well.
But it's the heavyweight tech names that are big parts of people's portfolios that are under pressure this morning. That's where the story is this morning. Yes, I think earnings are interesting, but it's this valuation story, Kriti, as you point out, that I think is the one that people are going to watch. ASML, biggest points drop this morning. It is down by 1.7%. Schneider Electric provides key components into the infrastructure that powers the chip story, is down pretty hard. Siemens is down 2%. So that's where the losses are coming through. SAP is down 1%. But you're also seeing in the mix as well some fairly decent losses coming through for the luxury sector as well. Luxury is down by 1.64%. Hermes is down by 2.5%. So that's an interesting narrative to that story too. So that's where the losses are coming through. But you don't have to get much further down the list either to find the other big driver of Europe this year, and that has been the banks. Banks are off this morning. And that kind of basically it's the things that have done well are selling off. Yeah. That's the narrative that we're dealing with this morning.
It absolutely is. Let's go and get a little bit more markets analysis. We should let everyone know that we, of course, are on watch for some comments coming out of Chancellor Rachel Reeves. When she starts speaking, we, of course, will bring those headlines to you. In the meantime, let's get a little bit of a read on these broader markets. Jeff Yu, Senior Market Strategist over at BNY, joins us around the table. Jeff, let's start with these markets. You picked a great day to join us because the markets are selling off.
Right. Is that how it feels?
In a very, very big way. Are you the contrarian indicator, I wonder? Just walk us through this kind of idea. We've been talking a lot on the show about this rotation, this valuation theme. Why now?
Well, looking at Europe, actually, based on our client flow data, this rotation or lack of buying in equities and going into Eurozone sovereign bonds or European bonds in general, that's been going on for a while now. One of the things we picked up, for example, during the French political saga over the last few weeks was basically consistent purchases in OATs, for example, gilts, especially on the part of domestic investors, they've done quite well. So there seems to be on the side, they're happy to keep onto their holdings, but any incremental gains in equities, our clients have been trimming at the edges and rotating into bonds, especially if you look at the UK, when yields are still quite favourable in nominal and real terms. Of course, let's see what happens today and with the budget later on in the month. But that has been going on behind the scenes. Now it seems like US and Asia are starting to catch up.
When it comes to that question, though, how much of the cue from Europe is ultimately being taken from the United States? If the U.S. is gaining, is Europe gaining? If the U.S. is selling off, is Europe selling off?
Well, it's the old adage, if the U.S. sneezes, the rest of the world catches a cold. And I think if U.S. tech sneezes, the rest of the world is going to, catch quite a larger flu. So in that sense, they will follow, where the U.S. is heading towards, because a lot of the demand is coming from U.S. capex. U.S. growth is driven by U.S. tech capex right now. So I think that's having a knock-on effect on Europe. And also that wealth effect as well, because if you look at U.S. households, if their portfolios right now is generating the wealth. You go around Europe, US tourists, you are feeling that. I've had some experience of that myself, for example. So if that spending is going to come down, I'm not surprised it's hitting the luxury goods segment.
Yeah, that's interesting. And talk to us about some more of those links and how a sell-off in stocks in the US could impact ripple through, more than ripple through, perhaps into other areas? And I ask this because, of course, we've had these warnings from big tech bosses, as Kriti says, big bank bosses about we could see weaker stocks. But our Markets Live team highlighting, you know, in the run-up to the dot-com bubble bursting, we saw plenty of pullbacks in stocks, and then we returned to the buying. I mean, things can get very choppy at the end of a bull market, was the point that our colleague Mark Cudmore was making.
And that actually introduces this notion of like a K-shaped recovery, or rather just K-shaped growth right now. And the US stock market is not the US economy at large. I think several policymakers and also executives have highlighted this as well. So, can the top brackets in the US, even with a pullback, with a 10% pullback, as some have mentioned, is that still from a high base and sufficient enough to continue to drive US growth? I think overall, if you get a valuations driven pullback, but underlying data when we get it, if that's still solid, driven by the top earners, then probably we can stabilise. So we just need basically data to see if there are actually any proper creaks in the US economy, and it's not there yet.
Yeah, we're talking about creaks in economies. We're going to be waiting to hear from the Chancellor. We are waiting to hear from the Chancellor Rachel Reeves. We've got live pictures of an empty podium, but she will be there shortly to talk to the room full of journalists in Downing Street. From a market perspective, she's somebody who is always emphasising the fiscal rules. No doubt that will be a feature of what we hear about today, or at least that'll be in her mind. What are you thinking about as we wait to hear from Rachel Reeves?
So let's combine this with the Bank of England later this week. Out of all the central bank decisions this week in Europe and in developed markets, I think the general vibe is the BOE is the only one that's actually still live. Our view is they're going to remain on hold, but there will be a push for a cut. So if you combine that potentially lower borrowing cost, and my own view is even if they don't cut this week, there will be a cut later in the year. So combine that with the attempt to build greater fiscal headroom. I think the markets have priced that, and we haven't seen any meaningful outflows.
Is there an offset? If she raises taxes significantly, is that a reason for the bank not to cut?
I think for the bank, so for now, they're still focused on inflation. So, that taxation versus inflation link, which several MPC members have talked about, if they can decisively break that, if inflation comes off because of fiscal restraint and there's a growth impact, then they can still actually move on rates.
The flip side is, you think if she raises taxes significantly, does it provide a reason to cut?
I think it's more they're going to go on the to-cut side because of fiscal restraint. Because if you are raising taxes and in an environment where the household is already pulling back, as, again, the BOE have highlighted, then will that be able to sway maybe 2 or 3 members on the MPC?
UK consumers in good shape, I thought. They're not spending, but in good shape. If you take a look
good shape, yeah, because real wage growth is decent right now. That's been highlighted, and that's driving the inflation impulse. But it's all about expectations at the end of the day, right? So if people, if the expectations are, their net incremental wage growth or income growth, rather, their disposable income is going to be held back due to tax adjustments, right, then I think you're going to feel that on the spending side.
Are some taxes better than other taxes? And I ask this not just for today's speech, but of course ahead of November 26th as well. When it comes to a market reaction, are some more digestible than others?
I would say from a Keynesian point of view, it's what you do with the taxes ultimately, because fiscal multipliers can be strong in the end. So if you channel the taxation back into investing in the economy, which drives a higher fiscal multiplier, which crowds in private capital, that can be seen as positive. So basically, it's to borrow almost a phrase from Beijing, you've got to invest revenues into productive forces, high-quality productive forces. I think that's what Beijing says. So in that sense, it can be positive. But what the sense, I guess, over the last 12 months is, yes, revenue generation has increased based on taxation, but has the investment followed through? If the efficiency of that investment has not been as strong, then you're not going to get the growth that you desired, and ultimately it's about growth.
And will gilt markets be slightly, if there is this more fiscal headroom, as Guy's just been mentioning, will there be a sense of relief that we don't have to be hanging on every word of government?
I think that will.
5 minutes to see whether we're next up against this fiscal headroom.
So if I look at our client flows, gilts have been fine, surprisingly, over the last few months or so, mostly based on domestic investors. So their flow's been anchored by good real rates and nominal rates, even though inflation's been high.
Here she is. Chancellor of the Exchequer has just walked onto the stage. Let's take a listen to what she has to say.
At that budget, I will make the choices necessary to deliver strong foundations for our economy. My budget, led by this government's values of fairness and opportunity, and focused entirely on the priorities of the British people: protecting our NHS, reducing our national debt, and improving the cost of living. There is a lot of speculation about the choices that I will make. I understand that. These are important choices that will shape the future of our country for years to come. I want people to understand the circumstances we are facing, the principles guiding my choices, and why I believe they will be the right choices for our country. We are a country with considerable economic strengths, an open trading economy, a global hub for cutting-edge industries, from AI to biotech, with world-leading universities and scientific institutions, and a talented and a committed workforce. But years of economic mismanagement has limited our country's potential, with long-term issues continually unchecked and potential unrealised. At the budget last year, I fixed the foundations, dealing with the aftermath of Liz Truss's disastrous mini-budget and the £22 billion black hole in the public finances left by the previous government. I put our public finances back on a firm footing, provided an urgent cash injection into our faltering public services, and began rebuilding our economy. But since that budget, the world has thrown even more challenges our way. The continual threat of tariffs has dragged on global confidence, deterring business investment and dampening growth. Inflation has been too slow to come down, as supply chains continue to be volatile, meaning the costs of everyday essentials remain too high. And the cost of government borrowing has increased around the world, a shift that Britain, with our high levels of debt left by the previous government, has been particularly exposed to. And in an uncertain world, we also face pressure to increase our defence spending, and it is right that we do that, protecting ourselves from hostile actors and supporting our allies. And there are other pressures on the public finances. The Prime Minister, the Secretary of Work and Pensions, and this whole government are committed to reforming our welfare state, so that it is not a system that counts the costs of failure, but one that invests in success and protects those who need it most. There is nothing progressive about refusing to reform a system that is leaving 1 in 8 young people out of education or employment. So we have begun the job of creating a system that protects people who cannot work and empowers those who can. And there are longer-term challenges too. That feeling, shared by millions of people across the country, that the economy isn't working as it should. Alongside the budget this month, the Office of Budget Responsibility, the UK's public finance watchdog, will set out the conclusions of their review of the supply side of the UK economy. I will not preempt those conclusions, but it is already clear that the productivity performance that we inherited from the last government is weaker than previously thought. A less productive economy is one that produces less output per hour worked. That has consequences for working people, for their jobs and for their wages. And it has consequences for the public finances too, in lower tax receipts. It's not a question of how hard people work. Poor productivity means that we're putting in more, but getting out less. It means too many businesses and workers don't have the tools that they need. Trains that run on time, broadband that's fast and reliable, access to new technologies, or proper training so people have the right skills for the job. For a long time, commentators have talked about Britain's productivity puzzle. But it's not a puzzle. The causes of our economic underperformance are well understood. The chronic stop-go cycle of public investment has left us with roads full of potholes, high energy prices, and unstable conditions for vital business investment in skills and technology. And long-term failure to invest in our regions has built growth on a narrow base, with some parts of the country forging ahead, while others fall behind. The truth is that previous governments have not adequately faced up to these challenges. Too often, political convenience has been prioritised over economic imperative. The decision to pursue a policy of austerity after the financial crisis dealt a hammer blow to our economy, gutting our public services and severing the flows of investment that would have put our country on a path to recovery. The years that followed were characterised by instability and indecision, with crucial capital investment continually sacrificed and hard decisions put off again and again. And then a rushed and ill-conceived Brexit that brought further disruption, as businesses trying to trade were faced with extra costs and extra paperwork. All this meant that when the pandemic arrived, our country was underprepared, our public services weakened and our economy fragile. And we finished the pandemic with higher death rates and higher debt than our peers. This isn't about relitigating old choices. It's about being honest with the people about the consequences that those choices have had. It is my job to deal with the world as we find it, not the world that I might wish it to be. Not to commentate or to speculate, but to act. In my May's lecture last year, I set out our plan for solving our productivity problem through a programme of stability, investment and reform. And when I became Chancellor, I began to put that plan into action, stabilising our public finances, making the tax and spending decisions to get debt down and to fund our public services sustainably, changing the fiscal rules to increase public investment by £120 billion over the course of this Parliament, and crowding in private investment too, for road and for rail, for housing and nuclear power, and reforming our economy, ripping up the planning rules so we can build housing and infrastructure right across the country, bringing the brightest and the best to our shores with a new visa regime, and signing trade deals with the EU, the US and India to help businesses export around the world. We've begun to see the results of those plans in falling interest rates and falling NHS waiting lists, in rising wages and rising investment. But I know that real progress takes time. Our growth was the fastest in the G7 in the first half of this year. I don't expect anyone to be satisfied with growth of 1%. I'm not, and I know that there is more to do. The first part of our planning reforms will add an additional £6.8 billion to the size of our economy in the next 5 years. But the next part, our planning bill, must complete its passage through Parliament before it can make a difference. Interest rates, which rose from 0.1% to 5.25% in the last Parliament, have now been cut 5 times. But at 4%, they are still a constraint on business borrowing and a burden on family finances. Inflation is already much lower than the double digits seen under the previous government. And the choices I make in this budget this month will be focused on getting inflation falling and creating the conditions for interest rate cuts to support economic growth and improve the cost of living. I understand the urge for easy answers. Politicians of recent years have become addicted to shelling out for short-term sticking plaster solutions rather than making long-term economic plans. They were irresponsible then. And those who continue to push for easy answers are irresponsible now. The UK's national debt now stands at £2.6 trillion, equivalent to 94% of GDP. Before the mini-budget, our borrowing costs were in the middle of the pack compared to other advanced economies. But now we have the highest borrowing costs of any G7 country. Today, 1 in every £10 of taxpayers' money is spent on debt interest. Not paying that debt down, but just paying the interest to our creditors. At the budget last year, I changed the fiscal rules to strike a careful balance, to invest more in capital alongside a credible plan to grow our economy and bring debt down within this Parliament. That was the right decision to break the cycle of low productivity and low growth. But that additional investment can only be delivered because markets know my commitment to the fiscal rules is ironclad. Some people say that we should just sidestep those rules, that we can borrow more without consequence by simply reclassifying areas like defence or education. But no accounting trick can change the basic fact that government debt is sold on financial markets. There are limits on the price that banks, hedge funds and pension funds are willing to pay for our debt. And we are competing constantly with other countries also selling debt. The more that we try to sell, the more it will cost us. It is important that everyone, the public and politicians, understand that reality. The less we spend on debt interest, the more we can spend on the priorities of working people. Our NHS, our schools, our national security. The public service is essential to both a decent society and a strong economy. At the budget last year, I provided our public services with a vital cash injection, and I am proud of that choice. Proud that it is a Labour government that is providing record investment in our NHS, getting waiting lists down by over 200,000 since the election. Proud that it is a Labour government that is investing in our children through the rollout of free breakfast clubs and free school meals. And proud that it is a Labour government that is funding our armed forces and remains resolute in our NATO commitments. The alternative is to row back on those investments, to return to the cycle of austerity and decline, which is what got us here in the first place, passing the cost of government failure onto communities and families, stifling our economic growth and weakening Britain's foundations in an unstable world. I will not repeat those mistakes. But if we want strong public services in the decades to come, then we must recognise that productivity and efficiency are not only a challenge for business, they are a challenge for the public sector too. At the spending review, I announced £14 billion of efficiencies per year to be delivered by 2029. Cutting government spend on consultancies, getting rid of bureaucratic quangos and regulators, and driving efficiency through AI and digital technologies. But I know that there is more to do. In the budget and beyond, I will continue to drive for more productive and more efficient public services right across government, making savings and rooting out waste wherever I find it. Now, my opponents will tell you that they could do more. Reform, who promise savings from our public services, and yet, in Kent County Council and councils they run across Britain, apparently they can't find a single penny, and instead going to increase council tax for more than 2 million people. Or the Conservatives, who promised £47 billion of cuts, when during 14 years in power they oversaw rising welfare costs and a growing civil service. What were they doing for 14 years? Let us be clear. There is no way that cuts on that scale, equivalent to cutting our entire armed forces or cutting every single police officer in the country twice over, could be delivered without devastating consequences for our public services. Austerity, reckless borrowing, made-up numbers. They are the problems, not the solutions. They are the mistakes of the past which would only take us backwards. I will not repeat them. When I was appointed Chancellor, people put their faith in me to take our country forward, not to be swayed by political convenience, not to always do what is popular, but to do what is right. At the budget, I will continue to deliver on the priorities of the British people, cutting NHS waiting lists, cutting the national debt, and cutting the cost of living. And in the context of the long-term challenges on our productivity and heightened global uncertainty, any Chancellor of any party would be standing here today facing the choices that I face. The difference is in the priorities and the values that will guide those choices. Mine will be a budget for growth, with fairness at its heart, and a budget that supports businesses to create jobs and to innovate. As I take my decisions on both tax and spend, I will do what is necessary to protect families from high inflation and interest rates, to protect our public services from a return to austerity, and to ensure that the economy that we hand down to future generations is secure, with debt under control. If we are to build the future of Britain together, we will all have to contribute to that effort. Each of us must do our bit for the security of our country and the brightness of its future. There is a reward for getting these decisions right. To build more resilient public finances with the headroom to withstand global turbulence. Giving business the confidence to invest and leaving government freer to act when the situation calls for it. To continue to invest in our infrastructure and our industry to build a stronger economy. And to get the cost of borrowing down, spending less on debt interest and more on schools and on our health service. The Office of Budget Responsibility will make their forecasts at the end of this month. But let's be clear about what forecasts are. They're not visions of the future. They're a look in the rearview mirror. The OBR rightly make their predictions based on the data that has gone before. But I do not believe that our past has to determine our future, or that a stuttering economy, poor productivity and falling living standards is somehow Britain's destiny. A brighter future is within our grasp. We were elected to break with the cycle of decline, and this government is determined to see that through. So we will go further and faster on planning, on the industrial strategy, on reforming regulation, all to deliver growth throughout our economy in all parts of our country. We will bear down on waiting lists, on the cost of living, and on the national debt, which compound these challenges. And when that requires hard choices, we will act, guided by the interests of working people. We were elected on a commitment to put country before party, the national interest before political calculation. And whatever challenges come our way, whatever challenges come my way, we will not be swayed from that. At the budget this year, I will continue to build the strong foundations to secure Britain's future, for a fairer Britain, a more prosperous Britain, a Britain with an economy that works for everyone. Thank you very much. I'll now take questions from people. Start with Beth Rigby from Sky News.
Thank you. Chancellor, you made history in your last budget when you increased taxes by £40 billion in the biggest tax-raising budget in over a generation. You said at the time it was a once-in-a-parliament tax-raising budget, and you told me explicitly Labour would stick to our manifesto commitment not to increase taxes that working people pay. Today, do you still stand by both those promises? And if you can't, or if you won't, aren't you making a mockery of the voters that put their trust in you at the general election? Thank you.
Thank you very much, Beth. I will set out the individual policies at the budget on the 26th of November. That's not what today is about. Today is about setting the context for that budget. And your viewers can see the challenges that we face, but the challenges that are on a global nature. And they can also see the challenges in the long-term performance of our economy. And the Office of Budget Responsibility will set all that out. They've done the review of the supply side of the economy. That looks at the past, but they use the past to predict the future. And as Chancellor, I have to face the world as it is, not the world that I want it to be. And when challenges come our way, the only question is how to respond to them, not whether to respond or not. And as I respond at the budget on the 26th of November, my focus will be on getting NHS waiting lists down, getting the cost of living down, and also getting the national debt down. Robert Peston from ITV News.
Chancellor, good to see you. You've just made the case, in effect, for raising taxes by tens of billions of pounds. The HMRC stats don't lie. If you do that, you will have to put up taxes for millions of people, including those you call working people, won't you?
Well, today is not about individual choices. They will be set out in the usual way in the budget. But what I want people to understand as we go into that budget is the circumstances which we face, and that is circumstances of great opportunities for our country, for the reasons that I set out, but also big challenges. And as Chancellor, I could do what previous governments have done, which is to sweep those challenges under the carpet, to cut capital spending to make the numbers add up, but then we'd be back here in a year or in 5 years' time with productivity still on its knees, growth underperforming compared with our peers, and the national debt continued to rise. So I'm being honest with people that at the election I said that we would put the national interest first. People can see that things are changing, that the global circumstances are challenging, and I hope they will see at the budget on the 26th of November that the focus on getting the debt down, getting NHS waiting lists down, and getting the cost of living down, which continues to be people's #1 concern, are the priorities that I will be focusing on. Neil MacDonald from Channel 4 News.
Hello, Chancellor. Concerns about the OBR's assessment of productivity have been around for years and years and years. You must surely have known this problem was lurking out there. Does that mean that you should have been clearer with people at the time of the election that you might have to put up taxes to deal with that problem?
Well, we did increase taxes last year at the budget to fill the £22 billion black hole in the public finances. Chancellor, of course, has to use the independent forecasts of the Office of Budget Responsibility, and we used those last year at the budget, at the spring statement, and at the spending review. But of course, it is their right to change those forecasts. But the most important thing is that we use those forecasts to underpin a budget or a spending review. And in fact, when a Chancellor decides not to do that, you go the way that Liz Truss and Kwasi Kwarteng did, where they wouldn't even allow the OBR to do a forecast. I have respect for independent economic institutions, whether that is an independent Bank of England or an independent Office of Budget Responsibility, and that's why I use their forecasts in the way that we should. But they will update, as we all know, their view about the supply side of the economy. They will set out the reasons for doing that and the reasons for their new assumptions on total factor productivity, the productivity predictions for the forecast. But forecasts are by their nature based on past data. I don't believe that the past is our destiny. I believe, and I'm determined to defy those forecasts, but it is right that we use those forecasts to underpin our economic policy. Otherwise, I'm afraid it is the road to ruin, which is the road that Liz Truss and Kwasi Kwarteng chose, which is why we still have higher borrowing costs than every other G7 economy. That was not the case before that mini-budget. I'm determined to bring those borrowing costs down and to bring our national debt down. So instead of spending £1 in every £10 of taxpayers' money on servicing our national debt, we can put that money to good use in our public services. Chris Mason from BBC News.
Thank you, Chancellor. Chris Mason, BBC News. I've got your manifesto here from last year, and on page 21 it says explicitly that Labour will not increase taxes on working people, which is why we will not increase national insurance, the basic hire or additional rates of income tax or VAT. What do you say to those who have listened to you this morning, and yes, they'll wait for your choices in a few weeks' time, but will say perhaps, crikey, it looks like the Chancellor's about to drive a coach and horses through either that promise or the promise from a year ago not to come back for more. And if I may, on last week's news, how did you manage to make such a mess of applying for a rental licence on your home, having championed the very policy yourself, and then managed to give one account to the Prime Minister, only to come back and have to give another one? Thank you.
So I will set out the specific policy choices on the 26th of November, and that's the right thing to do. And we're going through that process and the iterative process with the OBR at the moment, with the forecast and different policy measures. What I want people to understand, and I think it is the right thing and the courteous thing to do, to explain those challenges, but also the principles that will guide me in confronting them. And that's what today's speech is about. You know, there would be a different route through this, as I said in a previous answer. I could say, as I said to Robert, and what previous chancellors did, was, OK, we've got these challenges coming our way. The easy thing to do would be to cut investment in housing, to cut investment in energy security, to cut investment in our transport infrastructure. The reason we have such low productivity today, and the reason why the OBR are updating their forecasts, is because governments have done that for the last 14 years, and that's why we face so many of the challenges we face today. And I'm not going to be a chancellor like that. I am going to put the country first. I'm going to put the national interest first, so that chancellors in the future are not going to have to address the productivity puzzle. I don't think it's a puzzle, but the productivity problem that we face today. I'm going to take the long-term interests in our country's interest. And as I make those decisions, I am going to be laser focused on what I think are the key things for our country right now, and that is to get our debt down, because if we weren't spending £1 in every £10 on just servicing the debt, not even repaying it, but just on the interest costs, then we'd have more money for our NHS, or indeed money for tax cuts, getting NHS waiting lists down. We've already cut them by over 200,000 in the first year of this Labour government, but of course there's more to do with the waiting list is still more than 7 million, and to get the cost of living down, because interest rates and inflation, of course, are putting pressure on family finances in the same way that taxes put pressure on family finances. So I set out the circumstances that I'm confronting going into this budget, and also the principles, and then people will be able to judge whether they think I've made the right decisions. I will argue that they are the right decisions in our country's national interest. Of course, it's the role of others to scrutinise, but for other political parties, it's their responsibility to put forward an alternative not of fantasy economics like what we're hearing at the moment from Reform and the Conservative, but serious plans, because that's what these times demand. Ben Riley-Smith from the Daily Telegraph. Oh, sorry. And on the issue of housing, there was an exchange of letters last week between myself and the Prime Minister, and the Prime Minister's ethics advisor has passed his judgment. I don't have anything more to say than that. Ben Riley-Smith from the Daily Telegraph.
Thank you, Chancellor. It's pretty clear you're keeping open the possibility of breaking your manifesto. As you say, you want to do what's right, but not what's popular. If you look at history, often...
Well, I'd like to do both, but...
well, often...
But I will do what is right.
Well, often governments that have broken manifestos have been turfed out. Are you willing to lose the next election if it puts the public finances right?
But we've got to do the right things. You know, the problem of the last 14 years is that political expediency always came above the national interest. And that is why we are in the mess that we are in today. You know, there's no reason why borrowing costs in Britain should be higher than every other G7 economy, or why our borrowing costs are higher than in Italy or in France. The reason they are is because the damage done by that mini-budget, it might have been 3 years ago, but we're still paying the price of that. But also the price of keep racking up the national debt. 94% of GDP, £2.6 trillion. If we had lower debt and we had lower debt servicing costs, we wouldn't be having to make the choices that we have to make today. And I'm determined to put our country on a more sustainable footing. Public finances that are under control, public services that are properly funded, and yes, with a focus on fairness and on growth, because in the end, growth is the best way out of the challenges that we face. I set all that out, but if you're asking me what comes first, the national interest or political expediency, it's the national interest every single time with me, and that's the same for Keir Starmer too. Pippa Creagh from The Guardian.
Hello, you said that...
We've just been listening to Rachel Reeves, the UK Chancellor, there giving an address to assembled journalists, talking ahead of her budget at the end of the month. What was it all about? How have markets responded? Let's get some analysis. We've got Jeff Hughes still with us from BNY. But let's start with our UK correspondent from Bloomberg TV, Lizzie Burden, who is with us on set this morning. Lizzie, paying down the national debt got a lot of mentions. What stood out to you?
Yeah, this is pitch rolling for the budget. It's highly unusual, we have to point out, that the Chancellor should make a speech like this ahead of the budget. But you saw the market reaction initially seems to be what she would have wanted. Yields down. In fact, the 30-year yield at one point was at its lowest since April. But then it rose again. And we had the pound falling as well through the speech, but fluctuating later on. So what her message was I'm not going to tell you exactly what measures are going to be in the budget, but we do want to, as you say, get the debt down, which suggests, as the questions indicate, that we can expect tax rises and that the headroom is going to
I don't understand. What was that? Who was she talking to? What was the objective of this? The market's already assumed that taxes are going to go up. We knew that. You can tell that by all the questions that everybody's asking. So who was the audience for that speech that she just delivered?
Well, initially, when yields were falling, I was thinking it was the market. It was our viewers.
Yep.
Because I was thinking that if she wants yields down, is the OBR going to, the Office of Fiscal Responsibility, the fiscal watchdog, going to take this into account and give her more breathing room? But it's even not clear whether that would be the case. We don't know what snapshot of the market will be used for the forecast. I've been asking economists just this morning, and they say we'll find out afterwards. We don't know yet.
Yep.
And so it really seems like she's trying to pitch roll in terms of what measures there'll be. But if it isn't lifting the three main levers of tax, income tax, VAT or the payrolls tax, which would all break the manifesto, is she going to have enough room to be able to meet those ironclad fiscal rules?
All right, Jeff, weigh in here. I feel like you're buzzing to get something in. Your take?
Well, I think she was talking to the Bank of England as well. The fact that she referenced the base rate.
That made you sit up,
where it came, where it was, how much. Because if you want to talk about corporate borrowing costs, mention spreads, right?
Yeah.
There are a lot of things you can refer to when you say the cost of borrowing is too high from banks, not being generous enough and whatnot. But she referred to the BOE, so again, wonder if it's going to sway anyone on Thursday.
But Jeff, this was the Chancellor blaming the Tories when it's the ill-conceived Brexit, the pandemic, whatever it is. But what she didn't mention was the inflationary impact of her last budget, and surely that's the problem for the Bank of England.
And that's where the Bank of England will push back. It has been mentioned already in several speeches that we've seen that raised corporate costs and it was actually passed on via prices, right? So you can't expect the BOE to do everything.
Is the news today what she didn't say, and that is the fact that she would not stand by her manifesto commitment on not increasing taxes on working people. And Guy, you're right that the market was expecting taxes to go up, but maybe to take that out of the budget at the end of November, you have to say it now to get those headlines out of the way, to leave room to write other stories by the end of November. Is that what's happening?
So I guess I was just trying to condition everyone. There's some references to lack of accuracy in the OBR forecast. You didn't see it directly, but backward-looking data inputs. If the data changes, maybe she'll be able to change her budget as well or change her mind. So quite a few things in there, but I wonder if... so if I had my expectations, maybe 25-30% of a cut on Thursday, maybe I need to bump that up, just ever so slightly.
What does success look like in this budget? What does she need to do in this budget? She was trying to condition us for the budget. What does success look like for her? What are the main levers she needs to pull to deliver?
Well, success will look like lower yields, as Lizzie mentioned. That's going to how the market's benchmark on. I think sterling's going to be important as well. Whether you can actually have, let's say, even lower front-end yields, but without a massive decline.
But a base rate in December, the base rate cut in December from the Bank of England signals success.
I think that's in the price already, given just the state of the economy. The economy needs support, but if the market actually prices more in, because of some degree of fiscal restraint, can bring down growth and inflation expectations. So further down the curve, if we can have terminal rates, let's say, far closer to 3, maybe that'll look like success.
How much more can you tax the rich? We must be getting to the point at which, and I've seen numbers that suggest that actually putting up...
curves. Now, what's interesting is now that could be an element where she can put daylight between herself and what Nigel Farage mentioned yesterday, because he mentioned he wants as many rich people to be in the country as possible. Whereas in that sense, she won't say, I don't want more people who are wealthy to be in the country, but they would have to carry some load and pay their fair share. So I think that's where, on a policy basis, politically, where some divergence can come through.
Is it interesting the way that the bond markets responded through that? Because it felt as if we might be about to get some solid headlines on higher tax. And the bond markets, we saw gilts being bought, yields coming down. That was the trend across the globe because stocks are selling off, but more so in the UK. So does that tell us that if we do see taxes going higher, that the bond markets are going to deliver a positive response? Is that useful information for the Treasury?
I think markets were looking for some hard numbers today. So if your fiscal headroom or the gap, the expectations is X, and her delivery is X plus 5 or X plus 10, for example, then of course the bond market will react positively to that. But of course, you're going to have an impact in terms of the wealth effect and also overall growth.
OK, thank you so much. Thanks to Jeffrey Yu, Senior Market Strategist at BNY. Thanks to Lizzie Burton as well, our UK correspondent, for pulling all the threads together from that address by the UK Chancellor. Coming up on the programme, we check in on private markets with James Clarke, Blue Owl's Global Head of Institutional Capital. Stocks are weaker, concerns around AI. Does any of that feed into the private markets narrative that is busy financing the AI rollout? All of that conversation next. This is Bloomberg.
Tuesday the 4th, good morning. It's a busy morning out there. There's a lot going on. We've just been hearing from the Chancellor of the Exchequer here in the UK, Rachel Reeves. While she was talking, we've obviously watched what has been happening with markets around the world. Here in Europe, as you can see, we're seeing significant weakness. Equity markets have been rolling over. You saw it in Asia. You've seen it in US futures. It's being priced in to European cash this morning. So equity's definitely on the back foot this morning. Does that stick into the US session a little bit later on? And if so, for how long? We're going to wait and watch, see whether the dip buyers are back or whether this time, dare I say it, could be different, Kriti.
Absolutely. We've gone through all the threads of the major things that could be weighing on those equity markets. We've talked about trade, we've talked about earnings, we've talked about monetary policy, we even thought about some of the fiscal issues right here in the UK. We haven't yet talked about some of the private credit fears that are in the background. We've got the perfect guest for it. James Clarke, Global Head of Institutional Capital over at Blue Owl, joins us around the table. And just for our international audience, Blue Owl oversees almost $300 billion in private market assets. So we thank you so much for joining us.
Thanks
what a great
so much
time.
for having me. Yeah.
What a great time for you to join us. So we've got to ask you the question. We've had David Solomon over at Goldman Sachs say there's nothing to worry about. We've had Jamie Dimon talk about all the cockroaches that are going to come out in hiding after the collapse of Tri-Brands and First Color. Did I get the right? First Brands Tricolor. I'm so sorry. Completely flipped that in my head. But just walk us through your take here. Are some of these collapses emblematic of more to come?
Okay, so we're talking about 3 cockroaches, not a whole swarm of them.
I mean...
but yeah, I know where you're going to come back at me on. But look, here's the thing, right? 2 years ago, we were talking about the golden age of private credit. Now we're talking about cockroaches. So we've gone from the penthouse to the basement in a relatively short period of time. What stayed consistent amongst all of this, the thing that's been the least volatile, has been the asset class. It's continued to do exactly what it was set up to do. It was continued to do exactly what our clients want it to do, and it continues to solve its purpose in the portfolio. At the end of the day, this isn't a capital appreciation strategy. This is an income generation capital preservation strategy. It's filled that void. It's stepped in from being a tactical short-term allocation to being a strategic long-term, and the results are there. We continue to see that, and not only in terms of the returns they're generating, but frankly in the mitigation of risk.
So one of the arguments that this isn't, I'm going to come onto your side of the argument here. One of the arguments that this isn't a systemic or indicative of something systemic is that the lending growth is growing so fast, that the capital activity is growing so fast, that some of these pain spots is not enough to affect the entire system. My question to you is lending growth fast enough to offset the impact of some of these impairment charges? We haven't seen that on bank balance sheets.
Right.
They have taken a hit.
Right.
So is lending growth fast enough, or will be fast enough to offset them?
Yeah, look, I think the one thing, if I could just take you back a little bit here on these 2 names, or the cockroaches that you keep talking about, or everybody does for that matter.
Yeah.
What I would say is this. Number one, these weren't private credit issues. These were public issuances, okay? They were announced on a Monday. They were closed on a Friday. They were done in CLOs. They were broadly syndicated loans. This is a different field than what we're playing on where we're talking about private credit. Now, I could see that you're making the thread there through that, and that's... I see why people would arrive at that conclusion. But the reality is these are 2 completely different things. And if you actually have to look at where defaults rates right now are in the broadly syndicated loan market, they're at 4%. Where we traffic, the upper middle market,
They're 1.8% last year, 1.1% this year. There is a very distinct difference here in what we're talking about. So again, I think that you have to look at private credit isn't perfect. We're not looking to be perfect, okay? There's a reason we do 400 individual investments. Since our beginning 10 years ago, we've seen 10,000, in fact, 10,900. We've done 500 financings in general. Most of the time, what we do, is say no.
Yes.
Right? That's what we do. We say no. And we say no for a very good reason, because fundamental credit losses are an absolute non-starter. So again, if I could just, you'd be shocked at the amount of due diligence that actually goes into this. These are not companies, not private equity sponsors, by the way, that we've known for a short period of time, and all of a sudden they've come up and said, hey, we need a financing. Sure. They're groups that go back decades. Yeah. And I'll tell you one last thing before you cut me off, is that there used to be we used to get a lot of criticism because we predominantly operate in what's called the sponsor-backed market, which is private equity. And people used to say, well, private equity, they're taking your rate, they're getting whatever terms you want. The reality, and we'd done non-sponsored deals, but we specifically shied away from them. These are non-sponsored deals. There is an extra layer of insulation in there in sponsored.
So you say no, and there's an extra layer of insulation. We've got those messages. You join us on a day where stocks are weaker, and one of the reasons why stocks are weaker is because there's concern about AI valuation. How do you make sure that the businesses you invest in do not leave you exposed in some way to a loss of confidence in the AI theme?
Yeah, it's a good question. So we're one of the biggest lenders in software lending, okay? In fact, it would be among our best performing assets that we've had, I think, at least in the last quarter, if not over a longer period of time. There is a constant maniacal focus on, again, that theme of diversification, like end markets, critical end markets. How are we serving those? How are those software businesses serving those? And constantly re-underwriting the impact of AI and what that necessarily means for the business. Yeah. When you make a loan, okay, first of all, you've done all the due diligence. The second thing is you follow it from cradle to grave, right? You have people that are working on it, re-underwriting it every quarter, looking at it every day. You've got direct access into the financials. You've got direct access to the chief executive officers.
Okay. And I'm listening to all your messages, James, and because you've told us a lot that you do all this due diligence, so should we not be worried in the AI space that you talk about there, should we not be worried about the increased use of off-balance sheet financing, special purpose vehicles and all of the rest of it? Is this something that the market broadly should be concerned about or not?
I'm saying what I believe. I don't think so. I think what they should be fundamentally focused on is the relative returns. No one, by the way, is talking about the equity market being at an all-time high. Nobody is talking about where high yield is right now. Everybody seems to be focused on private credit, and I get it. It's the sexy headline. I click on it too. And I was a journalist in a former life, and you didn't get rewarded for writing articles about fairy floss and dandelions. You had to look into things that were potentially controversial. But no, I don't. And the reason I don't is because the volume of opportunity out there far outweighs the risk.
OK, James, thank you so much for joining us. Really appreciate it. James Clarke, Global Head of Institutional Capital at Blue Owl. It has been a very busy show as we've been listening to conversations around the UK fiscal story, talking about private credit. We've been watching European stocks drop, US futures weaker, kind of where we started the show, though. Nasdaq futures down 1.3%, E-minis down 1%. The European picture, then, Guy, weaker stocks as we sit here this morning.
Absolutely. So the Euro Stoxx 50 is down by 1.3% this morning. The question is, does this morph into something more significant as the day progresses? We've still got a whole raft of earnings that we need to be getting through. I do feel like the whole thing is, though, building 2 weeks' time. Nvidia's coming. It's a long way to go, but Nvidia's coming. Are we setting the stage for Nvidia? Anyway, the opening trade is done. We're through that. The pulse is coming up next. This is Bloomberg.